Good morning, and it's 17th of February, 17th of March, 2023, and I'm yet again here to claim a Nifty bottom again. And uh, but this time I have a deeper analysis, very deep analysis. I'll show you what I am watching and on what basis am I saying this. That Nifty has been bottomed out, at least an interim bottom has been set out. Last time, okay. Anyways, so let's go on and I'll show you what am I talking about. Well, I'll be talking about uh, the Nifty, of course, the technicals, and one of the most important data, which has been working for around 3 years. Around I'm tracking it for 1.5 year, and it's working pretty good. And that's the FII option data. Sorry, FII futures data. I'm talking FII futures data. And the other thing I watched out is the move index, the volatility index, the move index, that's the recession and the bottoming index. I'll show you that. So I've these three things. Firstly, let me show you the important thing. That's the FII data. So it's 17 March, and what what I just checked out was that FII long short ratio has gone to 11%. And this is historical that the FII long short ratio. How is this? This long short ratio formula is very simple. That's just you divided by longs plus the shorts. You just okay, so you get the ratio of the long short ratio. The long short ratio. Let me show you where it bottoms out, how it's bottom out. So I remember, and I have the data proof also. It's the June 20th June bottom, and very well remember that what happened on that date. The FII long short ratio was 15%. Can you imagine? 15% they were long. The long short ratio was 15% that day, and we bottomed out on that day. Okay, then we come to the 1 December. The top 1 December the top was made, and the FII long short ratio was 75%. And that day the top was made. In the 20, on 29th September, um, on the 29th September, when the September bottom, it was around 16,800, Nifty was back then. That time also, the Nifty bottomed out with a long short ratio of 13%. And today it's historical. Today it's historical that the data has come to 11%. This is not 17. This is actually the 16th March. That was 16 March data. No, it was 17 today. So the FIA long short ratio has come down to 11%. Can you even imagine how FIIs, how much FIIs are short? Now FIIs have to cover their shorts. There is no, there is almost a 99% probability of FII covering their shorts from here. It's impossible that that FIIs don't cover their shorts and the Nifty keeps falling to 15,000. It's impossible. It's possible, but it has a very low probability of happening. So so FII long short ratio is 11%. That itself is a big indicator that the bottom is in. So The technical is very simple. We are again back to the 1600 zone, and let me show you some. There is some. I think you cannot see the RSI reading. Uh, Now you may see that. Yes. So the RSI was 31, 30, 30, 30, 30 below, and 30 below. So and it's so RSI is also indicating an bottom of Nifty right now, and we are at we are we are below the two standard deviation, and we are at the 16,800 support also. So we can we will reverse very fast from here to set till 17,800. We're gonna go very fast. This was the reading of the yesterday. Yesterday I was saying reading 31. Yesterday I called it on the bottom, and again this trend line was also acting as a support. And also we are at the 20 monthly moving average also. So we may act as a support anyway anytime will coming soon. So another thing that I was taking care of was the move index. Yes, this is the move index. And what is move index? Move index is the volatility option volatility index that shows the volatility of bond options, not um, not equity options, but bond options, because the world runs on bonds more than anything. You know, bond market is way much bigger than the our index. So in 2008, the Lehman, the top of the move index was made at 266. Okay, and let's check out on which date did Lehman collapse. Lehman collapse date. It was the 15th December 2008 when the Lehman crashed. When the Lehman was out of the window, it filed the bankruptcy on 15th September. And the move index, where is the move index? And the move index on 15th September was already at 176. Sorry for that, 180. Here it was already at 162. It went up, and it was around October when the bottom of S&P was made around this. Yes, so it was around here when the bottom of S&P was made. So it indicates what are the bonds doing at the moment of the time. Here I see that the bonds, that the volatility and let me go to the 2020 also. In 2020 we made a high of around 164. The move index made a high of 164, and then it went down rapidly. So when the system is about to collapse, when the whole when the whole world is about to collapse, the move index goes shoots up. But when the things starts getting normal, back to the normal, move index cools down. So there's a very good story. And October also we attempted to move higher at 160, but at in October I remember that was the day of the Karwa Chauth, and that day the Dow moved up around 4% from the bottom when the move index cooled down here. I remember very closely because the central banks intervened and bought some and started providing liquidity into the system from the under table. Now the move index, now the move index made an high of one around 200, and it has cooled off 15% today. So this clearly shows that the worst is behind us. Whatever the worst has happened till now is over. It is up to three banks have defaulted. So for granted, many banks have collapsed in past 2 weeks, and the worst is behind us. We are not gonna fall now. An interesting thing that was noticed that see there is an interesting liquidity indicator. That's the Bitcoin is a great liquidity indicator, and you can see the liquidity has been pumping up in the system. Somewhere or the other way, the liquidity is being pumped into the system because it's a speculative asset class, and the speculative asset classes behave according to the flow of liquidity by the central banks. If the liquidity increases, the Bitcoin moves up. When the liquidity tightening happens, the Bitcoin crashes. You can check out um, in around the liquidity tightening started and it fell down. Now the liquidity is somehow somewhere it has started pumping into the system, and this is a leading indicator to show that we are it's a speculative asset class and we can use it to our own advantage. The third thing I'm going to show you is HYG, the junk bond index. The junk bond index, yes, this indicator is worth millions. And um, I would like to draw your attention to what can happen. See, HYG is the high yield corporate bonds that that uh, that you can say it's a junk bond. Like if you're getting around 15-20% interested on a yearly basis when the Fed is just providing 7% interest rate, so it's a high yield bond, and you can use it as an indicator of the health of the banks and the corporate authorities. This acts as a leading as well as a coinciding indicator of the stock market and especially the banks banking index. So, and in the COVID, it, it we bottomed out on in October when the Fed liquidity happened. When the Fed liquidity was spiking and the move index fell down from 160 to 150, and so the bonds rose up, and the COVID bottom was in. At that moment, we started moving up higher and higher, and now we are in a clear uptrend. This trend line might be some rough, but it clearly shows some kind of an uptrend. That's what I'm trying to convey right now. So we are most probably at the bottom because the junk bonds have also started moving up from here, and the move index has also started drying down. And the interesting thing that's to be noticed is the 10-year yield. The speed at which the 10-year yield is falling. See, the October top of the yields signifies something very, very important, that the market is bottoming down, and on the 10th of October, the market bottomed down. The speed at which the market is falling on the 28th February, I called it out the bottom because I thought that it may have bottomed right here. The yields have topped out and the market is ready to go up higher, but the yields are collapsing at such a vivid rate that it's clear that the interest rates have topped out almost the interest rates have topped out and the markets are pricing in that the liquidity is being pumped in to the system. Another thing that we look at is the US 10Y minus the US 02Y, the yield spread that's also cooling off. The yield spread is cooling off right now, and the Indian 10-year yields in IN 10Y. Yeah, Indian 10-year corporate bond yield is this is a very good indicator of predicting Nifty tops especially. So I checked this on the basis of this. I claimed at bottom at 17303, but it didn't work. Okay, so it it's a league lad, but okay, I feel to caught out the bottom, but it actually catches the bottom very well because when it tops out, the yield stops out. The There is a gradual lower ending pressure on the yields. So I think that the yields of the India yields have also topped out on the larger time frame. If you check it out, we're in a downward channel since ages, and we are we have rejected again. So it's a time we can call out the bottom again. See, I'm not joking. The indicator is a self worth of the proof that it catches the bottom itself. Yeah, we have lagged out with some issue, but okay, we have lagged out. But okay, I accepted. I lost it, lost the battle, no problem. But one thing is for sure, friend, that Nifty has bottomed out. That's it. There are a lot more things that I can discuss with respect to the fall and rise of the yields and the nationwide banks and whatever has happening. But this much, the FIA data, the MOVE index, the high corporate bond yields, and the Nifty. See, Nifty, if I talk about, if I talk about the Nifty, it's on the ending. I went wrong at that time, but technically also, if you look at it, it is at the bottom. I called it out the bottom. I called the bottom out here, but it didn't went well. Okay, and it's still and it moved up. So, and if I look at the monthly chart and just plot a moving average, if I plot a moving average and place a 20 monthly moving average HL2, so we are not gonna close below. This was at 17,299, and here I called out the bottom. It was here, right? Here you can see it was at 17,299. I thought it was the bottom, but it went down, and the Nifty has to close above this, and it cannot close below this because see the NAV pressure will be huge, and the that will be moving the Nifty up. There is a clear one more thing, that there is a clear divergence in the Nifty and Bank Nifty index. Let me show you. The Nifty was here and it fell down and broke the low significantly. But whereas if I talk about the Bank Nifty, it didn't broke the low so violently. It didn't break the low so violently. It actually signifies there's a divergence, there's an inter-market divergence right now in the market. And the one more interesting thing that I was tracking, the Bank Nifty upon the Nifty ratio. The Bank Nifty is outperforming. Bank Nifty has started outperforming again. Let me close this. The Bank Nifty has started outperforming Nifty yet again, and it's very evident that the Bank Nifty will outperform Nifty because our banks fell for no reason. But the the other banks, the banks outside that Swiss you and those all those banks fell for a reason. But our SBI, which is profitable, which is doing good, if it's falling, then it's almost illogical falling that banks like whatever is falling down, whatever is falling apart. That's just a foolish nature. So I think that Bank Nifty will rise much more faster than Nifty, and of course, of course, the Nifty will also rise. The Nifty has bottomed out, and that's for sure. That's for sure. The FII long short ratio, come on, it's 11%. 11% is not a joke. It's a bottom. It is a bottom, and I can bet $1 million on this of 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 this stuff. There is a reason why I'm talking like this. There is a reason. Of course, I went wrong at 17303. I accepted. But now the things have changed. So, whatever happened, happened. But we are moving much, much higher from here. We are moving much, much higher. So, see ya soon at 17,500 before the Feds meet. And I bet that on the Feds meet, we're going to go much, much higher. And before the Fed meet, we're going to reach 17,500. And the NAV has to close about 17,500 for the mutual funds as well. So we're going to rock in next 1 month. Okay. I hope you, I hope I added some value to you and would love to do so for you as well. Thank you.